everyone. Today we are going to talk about stock valuation in the equity section. The stock valuation is talking about calculating the intrinsic value of the stock. Then by comparing the market price of the stock with the intrinsic value of the stock, we can find out if the stock price is under or overvalued. Thus, we can make investment decisions. We have three major categories of stock valuation models. The first one is dividend discount model. And one of the most popular specification of dividend discount model is Gordon Growth model. The second one, we are using the relative valuation. We are using several financial ratios to do the multiplier model. By the way, the Gordon Growth model is absolute valuation, comparing with the relative valuation. And the third one is asset-based valuation, where we are using the balance sheet to see how much is the equity value. So today we are focusing on the dividend discount model, and also it is one of the most important calculations in the valuation part. Talking about the dividend discount model, it comes up with a very simple idea that the stock price is the present value of all cash inflows that the stock can provide. See, it sounds like the bond valuation. So we can start from the bond valuation. For the bond valuation, we also calculate all the present value of cash inflows by the bond. So we calculate the present value of all coupons. We are doing the discount here, and also the principal. This is the bond valuation. So talking about dividend discount model, it's similar to how we think about calculating the bond price. Yeah, it should be the dividend for each time. And we also convert it to the present value. So this is our first thought. But stock is different from bond because it doesn't have any maturity date. So we make an assumption that the stock has infinite life. And also, the dividend will not remain the same as the economic growth. So we assume increase rate. Of dividend, which is G. So from these two assumptions, we can rewrite the stock price from time 1. Suppose we know the dividend from now. So for t equals to 1, this is the increase rate of dividend. And also, we discount it by its discount rate. And yeah. We will continue doing this. Since it has infinite life, it's like a perpetuity. So it goes to d0, 1 plus g, and infinite, 1 plus r. This is the final equation. So we can find out it is an equal ratio series. So how to calculate it? Let's do something like this. You don't need to remember the calculation. I'm just showing you how the equation come from. I multiply this one to both sides. So for this part, it is we're actually talking about how to solve the opportunities. So let's see. What we can find out is this one and this one are equal to each other since it's infinite value. So infinite and infinite minus 1 is actually the same thing. So we can say that this part is equal to the stock price. Our equation so this is what we get. Finally, we are going to the golden growth model. The stock price equals to D0 multiplies the growth rate and R minus G. It also equals to D1 R minus G. And these are the ones you need to remember. We can also see that golden growth model also have some limitations, like it cannot calculate non-dividend stocks. And also the stock price can be very sensitive with the estimation of discount rate as well as the dividend growth rate. Next time I will talk about some changes and integrations of golden growth model. Thank you for watching. Hope it's helpful and see you soon.